Hey, it's Soleil, and this is episode 258 of the Orange Pill Investor. And today I kind of want to go back to the beginning and explain how I think about selling options like running a business. So let's just have a thought experiment. Let's say you're broke, you got no money, you got no job, but you've got a good credit rating. And some bank is willing to loan you money to start a business. And I'm just going to, let's just pick a number out of thin air, like, I don't know, $20,000. It just happens to approximately be the price of MicroStrategy times 100 shares, like that's 21.7, but we're going to round it off. And the only thing that would really matter would be, does this business generate enough income to pay the loan plus some profit? And I personally got a signature loan from Discover for 40 grand. And that's like 15.99% interest rate. Monthly payment is $795, so let's call it 400. And so if I had only borrowed 20 grand, let's just call that a $400 a month business loan. So in a business, I would have to figure out some way to sell something and get someone to pay me at least $400 a month so that I don't default on my loan, but preferably more than that so I can actually turn a profit. So what I do is, let's just say I took that 20 grand that I borrowed and I bought 100 shares of MicroStrategy. And then I go to the old options chain here. I could sell, and this is on Tuesday, so this is less premium than is even available, than would be available on, say, a Friday on expiration day, which is usually when I roll. But even today on a Tuesday, I could sell the 227.50 covered call, collect $400, and that's the loan payment for the month. And since there's 4 of these every month, I have choices. I could sell one every month, or excuse me, one every week, and pocket the other $1,200. So the 20,000 is paying for itself in 1 week, and then the other 3 weeks, it's all profit. Or I could just let this pay for itself, sell covered call against it in 1 week, and if I thought this was going to the moon, then I could just sit on my hands for the other 3 weeks, and maybe it does go to the moon. And then the first week of the next month, maybe I get $500 because the price of MicroStrategy is $250 or something. I can be as aggressive as I like. I could sell at the money for a week. That's, 150% of the monthly payment. That's forgoing all upside. So I'm not necessarily saying that I recommend it. I'm just saying that when people criticize capping, unlimited upside, why would you give up unlimited upside? Well, if I don't have any money, or if I've borrowed money that I have no business having because I just got someone else to give it to me on faith, then this is a strategy for the money to pay for itself plus some. And it only gets more, the more I borrow, the more premium I can make. And the more premium I can make, the more I can borrow. And really, the limit was just kind of like how much my credit score was taking a hit after getting a couple of these loans. And, you know, having a senior in college probably doesn't help either. So that's kind of the way that I look at this is I imagine the stock market as my business. We can call it Degenerate LLC or something. And it's MSTR is a little bit special because this kind of premium is not readily available. So even this at the money call, that's like 3% premium for less than a week at the money. But things that don't have the same kind of implied volatility, like Apple, their share prices are very similar. But even though Apple's a little bit of a higher of a price, there's nowhere near as much premium. It's like 20% less premium available. Now, the trade-off, and I don't know what Apple's chart looks like. It's up and down too. But let's just look at MicroStrategy's chart for a year. So MicroStrategy was at 50, went to 200, back down to 100. So we looked at a 4x and then down 50%. So what's Apple? Apple 170. When it pumps, it went up what, 10%? Like, oh no, it crashed. It crashed 10%. Oh my God, it pumped. Look at this giant ass green section here. Oh, wait a minute. That's what, $80. So that's 50%. That's pretty good. It's pretty good for Apple. Up 50% in April, May, June, July. Up 50% in 4 months. But it's not 4x. MicroStrategy, you're going to get a 4x pump to 200 and then a 50% crash. So if you can handle this, then, not financial advice, but if you can handle that kind of volatility, then you will have earned yourself the right to command this kind of premium. If you want Apple's growth and Apple's volatility, this premium might not even be worth it. It might just be like, fuck it, I'll just buy and hold. And so that's part one of how I operate my business. And I didn't come up with the idea of reinvesting the profits, like taking the premium and just plugging it back and buying shares. But the people that I followed, when they talked about it, it was like, okay, you buy enough shares and then, you use it to buy more shares and more shares and more shares, and you can sell more covered calls. And that kind of profit is additive. So if I make 1% premium this week and 1% next week and 1% the week after that, it's not 1% on top of 1%. It's not compounded. But at the end of the year, that would add up to about 52% returns, which is pretty insane. And just like, we're not promised number go up. So even though I can collect premiums from here to here, my overall portfolio is still going down 50%. So that's not necessarily what I mean when I say I'm going to get 52% returns. I'm only talking about the premium collected. So I don't want to mislead and overpromise that, you know, you're always going to collect premium and the stock price is always going to go up. That's not how the stock market works. And option selling isn't going to solve that problem. But once an account has accumulated enough shares that the premium collected is enough to be able to buy another 100 shares of something, then it's possible to collect your premium, buy another 100 shares of something, and then immediately sell an additional covered call, which now you've already collected 1% in premium, which you've reinvested and purchased 100 shares, which lets you sell another covered call and collect another 1% of premium. And if you're only collecting 0.5% a week, it makes no difference. You just need twice as many shares in order to get to this point. And as you can see with MicroStrategy, it's fairly elementary to find a strike where you can get 1% returns. And for people who are a little squeamish or, don't really want to be looking at their account every week, it's possible to go to 45 days, 60 days. Of course. In this scenario, I would be managing this every 2 to 3 weeks. And so even if I sold the 295, that allows for $80 worth of call away value, which is like 40%. Yeah, 10% would be 20. 4 times 20 is 80. And could sell that for $900. Manage that. Best case scenario would be managing that in 2 weeks, buying it back for $450. So if I'm making $450 every 2 weeks, that's $225 a week, which is right back to where we started. Trying to get, 1% a week. And so this has a pretty good amount of upside. Now, can MicroStrategy rip to 300 by 38 days from now? Absolutely. But it's still free money. Like, I borrowed this money that I didn't have, and because I have treated it like a business, now I'm using it to generate income. And eventually, if, collecting 1% a week, if I get to 10,000 shares, then that means I'm able to buy 100 shares every week. At first, if I just had 100 shares, if I borrowed 20 grand, had 100 shares, I could buy 1 share a week, and it would take me 100 weeks just to get to, it would take me 100 weeks just to get to 200 shares. And now I can sell 2 covered calls a week, buy 2 shares. It's going to take me 50 more weeks to get to 300 shares. And now I can sell 3 covered calls a week. And it's going to take me 34 weeks to get to my 400 shares. And this is all just like if everything works out perfectly. This is just complete fantasy here, because at some point the price is going to rip, shares going to get called away. So you might get up to 300 shares and then you might get knocked back down to 200 shares. But even if that's happening, the shares are still getting called away at a higher strike than they were purchased for. So in that scenario, I've still collected all of the premium and sold at a higher price than I purchased them. So I'm going to get the difference between my purchase price and the call away price as a profit, plus all the premium that I've gotten paid. So even that is not like the end of the world. But eventually, if I keep acquiring shares and acquiring shares and acquiring shares, at some point I get up to 10,000 shares. And if I'm collecting 1% a week, that means I'm buying an extra 100 shares, which now I'm not just making 1% every week, which is 52% a year. Now it turns into compound interest. And the formula for that is 1.01. Because that's 1% interest raised to the 52nd power because there are 52 trading weeks a year. So now instead of 52% returns, it's 67% returns. Again, this is absolute best case scenario, assuming no friction in the system. But of course, if you've traded options even one time, you can see that there's a bid-ask spread here. So in order to get into this trade, even though it says I can get paid $7.45, I might have to go down to $7.35 or $7.30. So there's slippage getting in. There's slippage, when I want to close the trade and roll it. There's friction in this whole thing. So I'm not promising that that this is absolutely achievable, and in exactly 11 years to the day of implementing this strategy, boom, you're a critical mass and you got 10,000 shares. That's not what I'm saying. I'm not saying that this is inevitable, but it's an interesting thought experiment, and it's how I kind of think about this. I want to just keep accumulating more and more long positions with the premium that I collected selling short against those valuable assets. And I have actually had to change this around a little bit. So this is kind of what I started with, but MicroStrategy during this bull market is so volatile that instead of buying shares, I started buying long calls. So to this point, I've ended up with 20 of these leaps, and I had a bunch of the shorter date ones, but I went ahead and sold those for profit already ahead of earnings. I just want to be careful around earnings because the number one rule of the game is to not get liquidated. And getting a signature loan from a bank that doesn't know even what I'm doing with the money and isn't going to penalize me for MicroStrategy going down, that's kind of best case scenario. And Saylor even mentioned that in his recent interview when he's talking about being a triple maxi, like, get a loan on your house, take out as much uncollateralized, what does it call it, mark to market loans as possible, and just go all in on Bitcoin. And even if somebody doesn't want to sell covered calls, I mean, I could have done that too. Just taken the 40 grand, bought 200 shares of MicroStrategy, and then every month to pay the $800, just sold 4 shares. And then at some point, as long as MicroStrategy goes up more than the interest rate I got for the loan, then I should be able to just pay off the loan and keep however many shares are left over. But I like this plan a little better. And that's how I look at it. I look at it as running a business. And I think that looking at it kind of unemotionally that way counters a lot of the criticisms that people make when they say, oh, you're trying to pick up pennies in front of a steamroller. And really, that saying gets thrown around anytime someone has the audacity to mention option selling. But that saying, as far as I'm concerned, specifically refers to selling naked calls. Someone that doesn't own the stock and is exposing themselves to unlimited risk. That I agree with. That is picking up pennies in front of a steamroller. But because I own the shares, there's no steamroller. The worst thing that could happen would be that my shares got called away, but that's still making a profit. So making a smaller profit than I could have made is not getting run over by a steamroller. That might be like getting my shoes stepped on or something. Like my new shoes that I just bought. Somebody steps on them and scuffs my new Jordans or something. But it's not picking up pennies in front of a steamroller. Anyway, that's my overall philosophy. I was repeating myself a lot at first, and then I think it's been a while since I really went back to basics and explained how I do this and why I do it and why I'm willing to sacrifice unlimited upside. And it's really just about servicing the debt, which I don't find terribly different than what Saylor himself is doing by borrowing money and then using that money to purchase an asset that he believes will grow in value more than the interest on the debt. So I just have to make sure that I'm selling premium or my asset goes up more than 16%, since I borrowed at 16% on one of the loans. I have a whole post where I laid out every single loan that I took and what the interest rates are and the minimum payments. But even if I did buy 200 shares, I can sell covered calls on one of them and get the premium for both 100 shares. So I can get limited upside on half of the shares and unlimited upside on the other half. Or buy 100 shares, sell covered calls to service the debt, and buy $20,000 worth of leaps. Five 450 strikes. Not financial advice, but this is how I run option selling like it's an actual honest to goodness business. And that's it for now. Be good, y'all.